I think, what was it? We heard a story one time that somebody told in one of our group meetings that there was a guy down in Louisiana, and after Katrina, he couldn't get a loan, and so he wanted to buy, what was it, like a wood cutting machine or something? To
Let's
it
go with
was
that. That sounds right. I know which story you're talking about. Yeah,
yeah, and
he couldn't get
he
a loan for the bank to do it because what collateral
right.
did he have? You know,
Yeah, and so he had cash in his policy, and he went and started a business, whether it was helping clean up houses or using it to cut up trees or whatever it was.
yeah, it having access to all lines of credit, regardless of source, in advance of emergency or opportunity is always good. Because now the nice thing about life insurance is that when banks say no, your life insurance automatically says yes because you are the owner of the policy. You have the fundamental right by contract to access your cash values at any time, as long as you have cash values in there. And one guy, Frank Abagnale's father goes in and says, I just need some time, somebody to beat these guys. Like, it's not a question of degree, or it's not a question of winning. It's a question of risk. Of course, he said, "Look, you're the biggest freaking bank in the world. Where's the freaking risk?" Um, I'm almost quoting verbatim there. But the thing is that when the banks and other lenders say no, your life insurance must say yes. So that's one huge advantage there. Now, going to the other part, which is tax deductible retirement planning. Now, often we're kind of negative on that, but at the same time, part of it is managing your taxes today, as long as you know what the future of those contributions is going to mean. So I'm not fully against it. You just need to be fully informed. So I don't mind a cash balance pension plan or a 412(b)(3) pension plan. And the reason I like those is because you can legally discriminate against 60% of your employees. These are owner focused, massive owner contributions into these plans. So you could put in $300,000, for example, and I'm going to use a rough number, 260,000 of it goes to you, and the rest of it goes to the employees that you choose. But the neat thing is that because it primarily goes to you, obviously you get the full 300,000 deduction in the year that you contribute, but most of that is going to be for your benefit. And it obviously favors the older that the business owner is. By